Thanks for clicking. Canada's fixed mortgage rates are on their way up as bond yields are surging upward amid rising inflation in the United States.
I don't know where all this is coming from.
And while we've talked about the reason for the increase in fixed rates, despite the Bank of Canada saying it's going to be cutting a few weeks ago, and the media caught up to it last week, fixed mortgage rates are continuing to rise, with some predicting that the 5-year fixed insured rate could go as high as 5.29%. And the upward pressure in mortgage rates is showing up in the real estate market, with weak demand for condos in Toronto, weak sales, and multiple articles showing homes selling for a loss. And the increase in fixed mortgage rates comes amid the release of the Bank of Canada's Summary of Deliberations, which shows that even when rate cuts do come, they're going to be gradual, meaning we're not going straight back to zero. Given the increase in rates, and as we'll see, the pared back rate cut expectations on the part of the Bank of Canada, this leads to the obvious question, where is the real estate market heading in 2024?
Upwards.
So what I want to do today is go over my best fixed mortgage rates for the month of April, take a look at the Bank of Canada's Summary of Deliberations, discuss some recent evidence that the real estate market is continuing to slow, and then go over some implications. The end of the month is fast approaching, and with that we are eagerly awaiting the release of April's real estate data coming out from the local boards next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage, if you'll remember, that's where you have less than 20% down. You have a 25-year amortization. You qualify at the contract rate plus 2% or 5.25%, whichever is highest. And of course, you pay the mortgage insurance. My best 5-year fixed insured rate in February was 4.89. That dropped down to 4.84 in March and is now up to 4.99 as of April. With my best 5-year variable rate mortgage sitting at prime minus 1.05 or 6.15. So 5-year fixed insured rates moving their way up much higher than they were last April when they were sitting at 4.49. Back when bond yields were about 80 or 90 basis points less than they are right now.
And that's the way it's gonna stay.
Next up, insurable rates. Insurable rates, that's where you have that 20% down payment, you have a 25-year amortization, you qualify at the greater of the contract rate plus 2% or 5.25%, and you don't pay the mortgage insurance. My best 5-year fixed insurable rate in February was 5.24. That dropped down to 5.14 in March and is now sitting at 5.24, with variable sitting at prime minus 0.7 or 6.5%. And similar to insured, insurable rates are also up about 50 basis points since this point in time last year, when they were sitting at 4.79. And finally, uninsurable rates, which are moving up, though by not nearly as much. Uninsurable rates, if you'll remember, that's where you either do a refinance or an equity takeout, and or you have a 30-year amortization. You qualify at the greater of the contract rate plus 2% or 5.25%, and of course you don't pay the mortgage insurance. My best 5-year fixed uninsurable in February was 5.57. That dropped to 5.52 in March and is now sitting at 5.67 in April, with variable sitting at prime minus 0.25 or 6.95%.
That's a good deal.
So we have insured, insurable, and uninsurable rates all moving upward in April, not by a massive amount, but given that yields are surging upwards ever closer to 4%, they will probably continue to rise unless we see a big reversal in bond yields. The last time yields were this high was back in November of last year, back when a 5-year fixed was sitting at 5.59. With that said, there is some hope at least out there that the Bank of Canada is going to be cutting rates in June, though those hopes have been dwindling as of late, down 30% since March. However, according to the Summary of Deliberations, the Bank of Canada says that even when rate cuts do come, they're going to be gradual. The summary was widely anticipated following the governor's press conference earlier on this month, as the governor told reporters bugging him for rate cut answers to take a look at the Summary of Deliberations.
And you will be getting the Summary of Deliberations in a couple of weeks with, well, we will expand.
Sorry about that, Governor.
Just eat what's on your plate right now.
In the summary, the Governing Council noted that there are growing signs that the economy is weakening, including lower job gains, increasing unemployment, and slow wage growth. The bank has been adamant that it wants to see lower wage growth and a weakening economy before it can cut rates. Further, the bank also noted that there are other encouraging signs on inflation, in that supply for right now is outpacing demand, and that's expected to continue. Corporate pricing behavior is normalizing, with inflation expectations coming down, and the bank is assuming that wage growth is also going to continue to slow.
It's never ending, your bullshit.
Given the weakening economy, slowing wage growth, and evidence that core inflation is coming down, the bank moved on to a discussion over how much evidence they need to see before they can cut rates. On the one hand, some members expressed a concern, like we've talked about so many times on this channel, that growth coming out of the US could prevent core inflation from slowing down even further, and that it could also accelerate. Other members of the council, however, noted that with the economy slowing down, there is a risk that the bank could keep policy too restrictive, meaning interest rates too high, than are needed. So it does look as though there's a bit of a split on the governing council, and there's also a split on the housing market. Some members are worried that when the Bank of Canada cuts rates, the housing market is going to take back off, while other members noted that that's going to happen anyway, regardless of the timing of those rate cuts.
You should really think about reading this.
So, we have the council noting that rate cuts are still probably coming, though the timing and extent of those cuts remain in focus. And this is probably even more to the extent today, especially given what's happening in the United States, which, as of today, showed higher inflation and slowing growth. So, fixed mortgage rates are moving upward. They're much higher than they were a year ago when the real estate market took off. And although the Bank of Canada still does plan on cutting rates, the timing and extent of those rate cuts remain in question, with traders drastically paring back expectations of a June interest rate cut. So what does all of this mean for the real estate market heading into the spring? Well, as we saw today, mortgage rates are on their way up almost 50 basis points since they were last year at this point in time, back when we started to see real estate prices surge back upwards. We don't have the real estate data out for the month of April as of yet, but at least here in London, we are seeing a major increase in listings and a slowing down of sales numbers, as well as a number of price decreases. Further, as mentioned, we're seeing more and more stories in the media, which is particularly curious, of homes selling for a loss. A recent Globe article noted that fickle home buyers are tiptoeing into the spring real estate market, with Toronto seeing a fresh increase in supply, but a dearth of home buyers. And it makes sense. Not only are home buyers hesitant to pull the trigger given what happened last year when FOMO was the message of the day, real estate prices surged upward into the summer, only to see all of that value lost well into the fall and the winter, but also the affordability just isn't where it was last year. Last year, a decent 5-year fixed insured rate was sitting at 4.49 and has now moved up and is inching very close to 5%. And we can see a lot of this hesitancy playing out in the Toronto real estate market. As of late, we've seen article after article showing a plunge in new condo sales, which, according to the supply will send prices up forever crowd, this really shouldn't be happening. As it turns out, Canadian homebuyers have long memories, definitely longer than the real estate industry, not that that's an accomplishment, and, as it also turns out, demand for a thing is directly impacted by the ability to purchase that thing. So, rates are up month over month, showing very few signs of slowing, and rates are also up year over year by almost 50 basis points. If that yield on the 5-year Canadian bond continues to move up higher, if it does pass that 4% mark, expect mortgage rates to move right along with it, with obvious effects on the real estate market. With that said, we will continue to track Canadian mortgage rates and their effects on our real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.